This channel is for educational purposes only. Please do your own due diligence before making any investment decisions. Hi, this is Joe Rabil with Invest Like a Pro, and today I'm going to give you an update on the stock market. We've had some volatility that just continues to take the market up and down all throughout the day. But on balance, it continues to remain weak and having a very hard time struggling off of this interim support level. So let's go ahead and get into the charts and give you an update. So in this review, I like to look at the market conditions, and there's a couple of conditions that I consider to be important but not timing tools, and the first is the sentiment numbers, and I use Investors Intelligence, bulls minus the bears, and look at that percentage. So if the number of bulls is greater than the number of bears, we have a positive difference. And if there's more bears than bulls, then we have a negative one. Now, I mean, we've gotten some time. There have been times over the course of the last several years where when the market gets these significant sell-offs, we move into negative territory. And so that's really what I think we want to be on the lookout for when we want to be aggressive buyers. And I like to use that in conjunction with coming down to either a big fib level, a major support area, or just some sign that there's a sign of climax, either volume or something like that. So it could play out that way, or the other option is to go down to a small time frame and look for a sign of a reversal. So we'll get into the smaller time frames as I switch over into the trend and momentum. But just so you know, the sentiment has moved to 8%. It was 15% last week. It dropped to 8%. So we're working our way closer to that zero area or even going negative. And if the market continues to struggle to rally here, we might get another little swift down move down towards the next support area, which I'll show again in a minute, but probably closer down to 4,000, 4,100 would be the target area. Now, the second indicator that is a market condition that's incredibly important, just like the sentiment, but is not necessarily a timing tool, is the volatility. And I use the average true range for this. So this is a market condition that tells you whether we have more risk out there and, you know, maybe how big of a decline we could get. Now, last year, I started alluding to the fact that I started wanting to focus in on this weekly because it had been so long that it had been in a downtrend below the moving average, and it turned back up and kind of held its ground. So in this case, the volatility not only gave us a condition of higher risk, it actually was a pretty nice, the signal was pretty timely. If we switch over to the daily, I wanted to just point this out. So we get a lot more signals with the daily, but during these periods where the average true range is rising above a rising moving average, that's a higher risk territory for the market. And we're in one of those right now. And that's kind of how I use this. But I also like to look at it and put it in perspective and see how high the ATR got at the last major bottom. And we still got some room. But here's the key. Back in November 19th, I'm showing an ATR, a daily ATR for the S&P around $36. And we're now up at 81. So that says that each day the market, the S&P, is trading $81 is the range per day on average, when back in this area, back in this range, it was trading around $36, $37 a day. So we've more than doubled the size of each bar per day in the market, which means risk is going up and volatility is going up. And when volatility is rising, if you're using the exact same strategy today, that you were using back in these periods where the volatility was a lot lower, you're going to get stopped out more. You're going to have a more struggle. It's just going to be difficult. So I like to use volatility to help to determine not only kind of what kind of environment I'm in, but also maybe to understand what timeframes I should be trading and what kind of strategies I should be looking at, and how much room I should be giving stocks, and maybe the size of the trades I should be playing. So that's kind of where we are with this. Higher risk from a sentiment standpoint is actually starting to improve, but we haven't gotten to a real climatic buy point. And the risk is elevated based on the high and continued high volatility. Let's go and look at the charts now. And what I've been talking about on this channel for probably, I don't know, 5 or 6 months is the fact that we were getting stretched away from the 18 month line. And what the momentum conditions on the monthly are really okay. If we go to the weekly, we started to see signs that the momentum was dying out. MACD was probably a little bit later, especially here is where we got a little bit more confirmation that the MACD wasn't confirming. But ADX started dropping off and really not confirming from this point on. So that brings us up to speed here. So now I think we want to really focus in on what's happened recently. If we look at the daily chart and we look at the strength of this decline, and then we get a reversal bar. Okay. Now the volume was pretty good. I mean, it was one of the bigger volume days that we have had. However, based on the violence of the move and the fact that the momentum was pretty strong, I didn't really think that that was climatic enough, in my opinion. And the other side of it is, normally if you're looking for climax, like true climax, it is going to come in the form of sentiment readings as well. Don't just use price and volume as a climax sign. If we're going to make a bottom in a climatic formation, we're going to be really stretched away from the moving average. Probably more than this. We probably need to be even more so on this, and it needs to show up on more than one time frame. It was really only extended below on the daily, and we really want to see it both on the daily and the weekly, I think, if we're going to hit a really extended region. And then I want to show you this. If we get extended on the weekly and we get extended on the daily, we're going to be down closer to the 18-month line. That's really the target for this move. Remember, it's been almost 2 years since we've touched the 18-month line. We're due. So I think that's the highest probability. So let's go back and look at this momentum. We had a strong decline, and then we tried to rally up. Now, as this is rallying up and turning, we want to pay attention to the ADX. If the ADX is rising, then we don't expect a rally all the way to the 18. Okay, you would use a lot of times I just draw on a dotted line at the midpoint between the 4 and the 18. You can use an 8, a 9, a 10, something like that. And this line is going to be acting as resistance. I don't actually have that line up, but I can just tell you we're getting in the area after 3 to 4 days going sideways of getting close to that shorter term moving average line, and we still have a rising ADX. So if we get a trigger on the smaller time frame, we can take that even though we're still stretched away from the 18-day. So I kind of think what happened here is we came down to a pretty key area. I've been highlighting on my report the 4250 this week is what I said. 4250 on the S&P up to about 4300 was the support zone. We came into that zone and we're trying to bounce off of it. But the problem I have is, look at the bounce. So we had one good reversal bar, an inside bar, and then we had a gap up that crapped out, gap and crap basically, and then another gap up today, Thursday, that gave it up. I'm actually doing this Thursday evening, just so you know, in preparation for Friday morning. So we have strong momentum on the daily based on a rising ADX, based on the fact that the MACD lines are pretty strong in confirming the move to the downside. But we got into this interim area, and I think it tried to hold, but we haven't had enough strength. Now, if this can hold these last 2 or 3 days lows, that's probably a sign that we could get a little bit better rally. So let's go to the smaller time frame. I want to show you what. Let's look at the hourly chart. So one thing I wanted to mention actually is, yeah, I actually don't have that chart up, but go, if you have pulled up your RSI, if you have your RSI on here, we got a super overbought reading in the 5 RSI, and the 20 RSI stayed below 50. So we had that. The one component was missing in this trade is that this price, this moving average turned up before we got a trigger to the downside. So it wasn't really one of those signals. However, notice this. We have a significantly lower peak here. And if I pull up the MACD actually made a higher peak. So that's reverse divergence, pretty dramatically so. The fact that this one is such a significantly lower high right at the 40 moving average. It's the same thing right out of my book. It would have actually been just a great signal if this made it all the way back to the 0 line. And we're still kind of working this off. Now, because we didn't make it all the way to the 0 line, and the fact that this moving average turned up on the 18, I would have probably been, my suggestion is for you to be, if you're looking for this as a trading play on its own, not a hedge. So we put on a hedge in here because of what was taking place and the fact that there wasn't a great rally taking place and all that. But if you're actually looking to short this as a trading play, I think you actually need to go down to the 10-minute chart, and you would use a 1, 2, 3 trade. And if you notice what happened, we broke the trend line, came back up. Now, the aggressive trade is taking out this low right here. Instead of waiting for the 3, you let this come down through this prior bottom here, and that's kind of the trigger on the 10-minute to get you in on the hourly daily setup. Now, we haven't really followed through from that yet, and one of the reasons is that we don't have a full-fledged 1, 2, 3 to the downside. That low needs to be taken out to confirm the 1, 2, 3 to the downside. And so that's kind of where we are right now, going down, starting with a monthly, working our way down to the weekly, looking at the daily, and the fact that it's stretched away from the 18, but there's very strong momentum characteristics in place, so we can play the trade on the hourly. And now we're waiting for really confirmation on a 1, 2, 3 basis. I think if we take out this horizontal line, there's a pretty good chance we're going to go test the lows and potentially start another leg to the downside. I mean, this is pretty rough price action. The Qs have actually been worse and weaker. It's already at the 18-month. So this is kind of a pretty big negative. We dropped all the way to the 18-month and we can't rally, okay? So that's not really what we want to be seeing here. We'll just have to see the reaction. We're still hanging at the 18-month right now, so it isn't an official breakdown, but we're running out of time for the month. It is the, what day is it? 27th. So we have till Monday before the month is over. And when that happens, then if this bar is down like this, we have a big red bar, then we could have a pause bar, yes, to follow. But that's a big, huge selling bar closing right on top of the moving average. That would scare me a little bit. So anyway, that's the update for the week. Go ahead and post any questions or comments. Thanks.